In this video, we're going to talk about Aterian, trading under the ticker symbol ATER. Over the past few days, ATER has been one of the most popular stocks to talk about and to traded in the financial markets, and more traders want to get exposures in Aterian. So we're going to talk about how the stock is doing, why is it so popular, and what are the hints about where the price may go. Before today's video begins, if you like my content, please like, comment, and subscribe to my channel for more stock analysis videos. Aterian is a consumer products company. It has its brand of home and kitchen appliances, beauty products, and consumer electronics. Recently, the company has been the center of a lot of attention and speculations between those who want to short sell the company and those who want to short squeeze the short sellers. Basically, the reason behind this current dynamic is because, on one hand, the short sellers want to push the stock price lower because the company is incurring operating losses. They can do this by borrowing shares and can sell the shares at a market rate and recover them later on, and to make the money with the difference of prices between when they sold and when they recovered the positions. The issue about short selling is that this is basically a borrowed position. So eventually they will have to recover back the shares that they borrowed from, and eventually they have to recover those shares that they borrowed from brokers and also have to pay a periodic financing cost as well. With that being said, there is also another kind of short selling that consists of shorting a company stock without having to recover the position. It is no longer authorized by the SEC, and right now there are a lot of suspicions surrounding Aterian equity of whether the short sellers have been shorting the stock without actually the counterparty that they're supposed to recover eventually. One way to determine whether this phenomenon exists is by looking at the FTD positions. For Aterian, it seems like there have been a huge surge in this phenomenon since September of 2021, and many of their shorts should normally be recovered by October or November. In other words, the longer they wait, the more the short positions the institutional traders have been shorting the company should be recovered. So if there is no such recovery going on, then the regulators may be compelled to start investigating whether there are issues with the market participants. And recently, there has been a major development. The CEO of Aterian stated on Twitter that they are now investigating what is going on with the short sellers to determine if all the actions are above board. This email shows that the short sellers may be under more scrutiny than ever before, and if they don't exit their position with a profit soon, they may have to recover with a loss at a later date. What seems to be happening here is that the short sellers have to figure out a solution by about November 2021. Otherwise, the massive amount of short positions should normally be recovered. And if they're not, then there may be investigations from regulators this time. Personally, I think that there are real possibilities that Aterian stock is going to have more and more reasons or pressure to go higher over the next couple of weeks, because the short sellers would have less and less space to wiggle. Of course, given that nothing is guaranteed in this market, I think that we gotta play safe regarding the position and to control our exposure to what we can afford to lose. In this case, I would recommend a maximum exposure of 5% of your portfolio. The profit taking should be considered once the stock has reached its previous peak during 2021, which is around $17 or $18. Looking at the current environment, I think we have to be careful about having exposure in equity market to begin with, because it has been predicted to eventually go through a major pullback or even a recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the QE years and the drastic increase of asset price with the corresponding collapse of their yields, we gotta remember that the market is not a mirror on how the economy is doing, because otherwise we would have seen a market trading a lot more sideways. And then 2020 saw another big push in asset prices, and this time not just for the blue chips, but also the growth stocks. There are generally two explanations. The first one is that more money has been printed across the world. And because the real economy has been stagnating over the years, the capital then entered the huge melting pot of globalized finance and was used to buy up the asset price. That was the case for more than a decade, but now that QE has been touching its end in North America and in Europe, they are considering to slow down the speed at which they want to print the new money. In other words, new money printed by governments around the world will no longer necessarily play a key role in continuing to maintain the asset prices up. But this phenomenon is also compensated by the increase of geopolitical tensions around the world. And the more tensions there are, the more money tends to flow to the US and North America because it's still perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoils or social unrests. One last phenomenon is the attempt of the market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that asset prices in those sectors remain high, but not only because of their fundamentals. Sometimes it doesn't matter at all. Sometimes it's literally because everybody wants to not lose too much money, so they all jump in a hot sector. What all these mean for the market is that the degree of uncertainty will increase over the next month and years, especially as the expectation for a recession is building up after the party of 2020 and the recent announcements from the US Federal Reserve about the possibility of a recession in the short-term future. All these contribute to a higher degree of an inherent risk. These elements led me to conclude that it is very important to keep your speculative plays at a reasonable level. A healthy portfolio should normally contain a high percentage in positions from sectors that are different and mature, with stable and predictable cash flows. Those instruments may include, the common stocks from utilities or blue chips, REITs, fixed income assets, and preferred shares. The rest should then be invested in growth stocks or to remain cash heavy in the case there is an opportunity to scoop the bottom. Overall, I think that the current environment does make me believe that there will be opportunities to average down the cost basis, and this is why the initial position should be small enough so that we can afford to average down further down the road. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.